So this one is kind of a bonus one that we put in really to kind of coincide with the start of the new financial year, where we were keen to take you through our latest kind of prioritisation efforts as kind of an effort to improve how we go about just kind of communicating some of the key milestones. So we really want to take you through some of the work over the last year or so in our efforts to improve the quality of our economic statistics, but also point you to some of the milestones over the coming months and years as to where we're looking to make further improvements in terms of how we go about producing some of our key economic outputs. So you're going to be hearing from two speakers today. Firstly, Megan Cooper is going to take you through some of our recent updates on the Economic Statistics Plan and Survey Improvement and Enhancement Plan. You're also going to hear from Hera Boville, who's going to take you through some of our latest updates around labour market transformation. We're also aware there's plenty going on in the UK economy today, particularly in respect to some of the potential inflationary impacts that might be kind of feeding through from some of the escalation that we're seeing in the Middle East. So Grant Fitzner is going to take you through what do we know so far in terms of these impacts on the UK economy, both from our kind of business surveys perspective, but also some of the latest CPI and PPIs that were published last week. We'll then have a bit of time for Q&A as well, and as always, we welcome your feedback there and participation. So if you just go forward one slide. We'll be doing that via Slido per usual, and the code for that is 31779. So if you post any questions that you've got, I'll try to get through as many as I can in the time that we have. And also kind of keen just to encourage any participation with respect to kind of social media. So the hashtag for today will be ONS Econ Forum. And if we just go to the next slide, just one bit of housekeeping is, and this is in response to some user feedback that we've had, we'll be recording today's economic forum. We're going to cover the presentations itself so that those will be available for those who have not been able to make it today. And we won't cover the Q&A, but as I say, we'll get through as many as I can in the time that we have. And at that point, I'm going to hand over to Grant to take us through the state of the economy.
Hi everyone. So this is a relatively short kind of state of the economy, so I won't be covering trade, labour market and a couple of other key indicators, really just focusing on the recent global energy shock and the kind of potential impact that's going to have on the UK. So let's turn to the first slide, where this shows I think something we all know, the impact of higher crude oil prices on petrol and diesel. What may not be clear from the chart is is that the petrol and diesel do rise, but about 2 weeks after you get that big uptick in crude oil prices. Also worth reflecting that although motor fuels were a key factor in higher headline inflation, there's still more to come in terms of higher petrol and diesel prices, which are not yet fully reflected in our headline inflation numbers because they were kind of an average for March. When we publish the April figures, we expect that those will show higher petrol and diesel prices than the month just gone. So that's the immediate effect. There's a more lagged effect, though, in the UK due to kind of a regulatory quirk. So if we look at the next chart, this is Ofgem utility prices, and people will remember, I think, the energy price guarantee cap back in 22-23 as a response to the 2022 invasion of Ukraine and higher European gas prices in particular. The forecast at the moment, and just to be clear, these are not ONS forecasts, these are an average of 3 major supplier forecasts, is that from July, the cap will increase from where it is at the moment, but they're not expecting it to get back to kind of those 22-23 levels. Now, of course, those are just forecasts, they could change, but I think what this means, if true, is that yes, we will see higher energy prices, higher utility prices for households, but not necessarily as bad as we saw a few years ago. Also worth noting that this is for residential households. Some businesses are already facing high utility charges, so that will be adding to their costs. Next slide, please. Now turning to our kind of monthly producer price numbers, which we published last week. The navy line is input prices, so mostly the cost of raw materials, energy, etc., feeding into manufacturing, and then the green line is what we call factory gate prices, the prices as they leave those producers and go to wholesale suppliers. Now you can see that really big, that quite notable uptick in producer prices for inputs, mostly reflecting higher crude oil prices, which rose, I think, 88.8% last month, the biggest single monthly increase we've seen since this series began. But the green line for factory gate prices haven't really picked up yet. Petroleum prices were higher. Prices for some manufactured goods were prior. But as we saw back in 22-23, if you compare the two lines, then factory gate prices don't tend to increase as much, and they always increase with a lag because it takes some time for those higher material costs to be reflected in wholesale and retail prices. And also, suppliers often kind of smooth some of those kind of price adjustments and absorb some of the hit, if you like. Now, that can see profit margins in wholesale and retail trade fall. That can potentially be bad for employment and investment, but certainly does dampen some of the inflationary effect for consumers. Next slide, please. And here you can see our headline consumer price inflation numbers. And I think it's notable that although we saw an increase in headline inflation from 3 to 3.3% last month, core inflation actually fell a little bit to 3.1%. So we're in the slightly unusual period that core inflation is below headline inflation. That may well turn around over the next 6 months, but I think it's worth noting that core inflation strips out some of the more volatile elements like energy, and it takes some time for higher energy costs to move from, if you like, motor fuels and utility prices through the wider economy in terms of raising costs, particularly in more energy intensive industries. It does eventually happen, and it can also potentially flow through to services inflation as well, but it's not in the numbers yet. And we just kind of provide a number of different measures of core inflation. There's the measure which excludes volatile items. We have also a 15% trimmed mean and a median CPI. But as you can see, they've all been trending lower over the past year or two. Next slide, please. So turning to our big survey, this is our fortnightly survey of business. And just to explain these three lines, the light blue line is what businesses are reporting, where businesses report that they have raised their prices in the past month. The green line is where the price of materials has gone up in the past month. And the navy line is their expectations for what they're going to do about prices in the month coming up. Hence, it's more up to date or reflects a later time period. And as you can see, that price expectations of future prices are picking up, and that largely reflects as an increase in prices of raw materials or inputs into business production. No real surprise there, but I expect we may see further increases in both prices bought and price expectations in coming months if these higher energy prices continue. Next slide, please. And then just turning to one of the estimates for inflation expectations, these are the IMF estimates that were published recently. They show, as you would expect, higher inflation expectations across a range of countries, but I think it's quite noticeable that Germany and the UK are expected to see a larger increase in energy prices than some of the other countries. France, much less. Of course, France is much more, has a larger nuclear electricity supply and much less reliant on gas for its energy. Next slide, please. Likewise, Japan. Turning to UK GDP, we published our monthly GDP lately. So these are the numbers to February. And what the chart shows is the rolling 3-month, or if you like, quarterly change. So the last 3 months compared with the previous 3 months. As you can see, it dipped late last year, has picked up quite strongly, driven very much by growth in the services sector, but also a pickup in production. One of the factors dragging growth down in the second half of last year was the kind of cyber issues facing the UK car industry. That was a major drag on growth for a couple of months, but that sector has now fully recovered. On the other hand, construction has been weak for some time. We've seen significant falls in construction activity driven by weak house building in recent months. But certainly services and production looking quite healthy at the moment. No guarantee, of course, that that strong growth will continue in coming months, particularly given the energy shock that we're now facing. And I think the general expectation, this is also reflected in the IMF growth forecasts, is that we will see weaker growth than was previously expected in 2026. Next slide, please. Just turning to another big survey, this one asked businesses about what are the major challenges to their turnover. Bit hard to distinguish some of the lines, so apologies about the shading here. But the blue line at the top that's picking up is businesses that are saying that economic uncertainty is a major turnover challenge. So well over a third now of businesses saying that's a challenge. And also more are reporting cost of materials picking up. And I think it's noticeable that this was taken fairly early on in the outbreak of conflict in the Middle East. So it may not simply reflect higher energy prices, but other factors as well. Now, generally, when you have periods of greater economic uncertainty, business tend to postpone investment decisions. They may also postpone hiring decisions. And the last couple of years have been periods of elevated economic uncertainty, really going back to kind of early 2025, if you look at the chart. That has occurred at a time when we've seen a significant slowing in private sector employment. So I suspect the two are not unrelated. Next slide, please. Right, turning to public sector finances, I thought it was kind of worth mentioning these, considering we're kind of at end of the financial year, where we kind of typically take stock of how public sector borrowing and finances have gone over the past financial year. The chart this is a chart of public sector net financial liabilities. Now, fairly recently, the government switched from using public sector net debt to public sector net financial liabilities, which is a broader measure than debt alone. The green component is that net debt figure I mentioned, but it also includes other financial liabilities and financial assets. So it's a broader measure. The other thing to be aware of with this chart is that even though those numbers are going up, that doesn't mean that actually means that liabilities, net liabilities, are going up. So in a sense, it's actually a growing deficit or a growing liability. For some reason in the UK, we present these as positive numbers rather than negative, but they are actual deficits. So that shows a consistent pattern of deteriorating public sector finances going back to around 2006, 2007. In terms of one of the factors that's a major drag, let's just turn to the next chart, that has been, next chart, please. I'm sure it's coming. No, could we go back to the next? There we go. Thanks. This is 10-year government bond yields. We're just putting three on the chart. So the purple one is German bonds, which historically have been lower than US and UK bond rates. The green is US treasuries and the navy is UK gilts. Now, until fairly recently, I think there's been UK bond yields, government bond yields have typically followed US treasury yields very closely. I think what's notable in the last year or two, if you started to see a bit of a split between them, with UK gilt yields trending higher than treasury, which basically means that the bond traders think that there's greater risk attached to our gilt or higher inflation risks and want a greater premium in order to hold them. Now, that can be a challenge when you have large public sector debt and liabilities. And I think what's particularly important is that that also means higher debt servicing costs. And that translates through two means. One is if you're issuing new debt, new bonds, you may have to offer a higher interest rate than perhaps you had in previous years. But also around 20% of UK gilts are directly linked to the retail prices index. So of course, every time inflation picks up, the payments on those gilts picks up as well, and that can transfer through to higher interest rate borrowing costs fairly quickly. So we are clearly in a period where inflation is heading higher, and the retail prices index will be one of the indices that moves higher and add to those borrowing pressures. So not great for the public sector outlook. Higher inflation and lower growth typically are not good for public sector finances. So I'm sure the Treasury will be watching with great interest to see how quickly the current conflict ends and, if you like, things return back to normal. Just a few concluding remarks. pretty much summarising what I've said already. The first is that clearly we're seeing elevated energy prices. An important point about these is that although we're seeing petrol and diesel prices pass through almost immediately to consumers and utility prices with a bit of a lag, the expectation that things will go back to normal once the conflict is resolved are probably not correct, because a significant amount of transport, logistics and refining capacity has been damaged, and it may take some time for them to be repaired. So I think it's reasonable to expect that energy prices will stay elevated for some time, even if the conflict is quickly resolved. Next point, please. So obviously we're seeing that flow through to input prices. It will, with the lag, flow through to headline consumer prices. Core inflation is also likely to pick up, but with a lag. And in terms of the growth implications, obviously growth forecasts are likely to be revised down for 2026. But clearly the extent to which this impacts on growth depends on how high energy prices go and how long they stay elevated, and no one really is able to predict that with any degree of certainty. So you should take those forecasts with a grain of salt. And as I said, businesses reporting greater uncertainty, higher material costs, and more of them expect to raise prices in the coming months. And then just finally on public sector finances, we're seeing public sector debt, net debt and financial liabilities trending higher, partly due to those high government bond yields that I mentioned adding to borrowing requirements. That's it from me. I'll pass on to our next presenter.
Thanks, Grant, and good morning, everybody. Great to be here. I'm Megan Cooper, so I'm the Director for Economic Statistics Improvement at the ONS, and recently taken on responsibility for the delivery of the Economic Statistics Plan, and we'll be cantering through a few slides of progress for you today. So if we can flick on to the next slide, please. So we've recently published the latest quarterly update against both the Economic Statistics Plan and the Survey Improvement and Enhancement Plan. Publications cover the last quarter from December to March, and have taken into account feedback that we received on previous publications from the OSR, and of course, obviously, their original recommendations in terms of making sure we're publishing those updates on a quarterly basis for our stakeholders. Next slide, please. So both plans are complex, both plans are ambitious, and they're multi-year plans. So some activity will undoubtedly extend beyond a 3-year time horizon, but we're committing to making sure that we're really transparent about the progress we've made, challenges we've encountered and how we're responding to those, but also what we've learned and how we're continuously improving how we deliver on those improvements that we want to see. Next slide, please. So it's been a busy and productive year. The last quarter of the financial year, we've shown particular progress. The quarterly updates are a really good moment in time to step back from the ongoing delivery and the hard work that the teams are involved in, and reflect on the progress that has been made and how it's impacting our statistics. Next slide, please. So go straight to the next slide, if that's okay. Thank you. We've made some really strong progress. We've completed 65 of the 93 plan milestones, so 2/3 of what we set out to achieve. The fact that we didn't deliver 100% is an indicator of the level of ambitions in the original plans to start with, and we'll go through some of that progress in the following slides. Next slide, please. So yeah, the last quarter of the financial year tends to be when we get a lot of delivery from the plans for the full year, so they tend to come to fruition at the end of the financial year. And the most recent publication highlights some of the key achievements that we've made, and we're going to touch on some of those most impactful improvements in the following slides. So I'll give you a quick canter through those as we move through. Next slide, please. Work undertaken in the last year has now started to feed into and have an impact on the statistical outputs, and the end-to-end quality reviews that we're undertaking is helping to pinpoint where we need to focus and or change our focus indeed, to make sure that we are actually having sustained improvements to the quality of the statistics. Next slide. So the labour force survey then, response levels on the labour force survey has shown clear improvement, and all waves are now close to pre-pandemic levels. So this is going to significantly strengthen the quality and the confidence we have in the core labour market outputs. So that's a great achievement. Next slide. On the transformed labour force survey then, the short core version of the transformed labour force survey has helped to reduce partial responses that we were receiving, and it's increased the number of full individual responses. And all of the planned design changes for the survey are now implemented, and you're going to hear more about transition dates on LFS to TLFS a bit later on from Heather. Next slide, please. Business surveys. So we're also seeing improvements in business survey responses, and we've expanded case management, now covering nearly 500 reporting units. Next slide. And learning from the errors. So while the number of major errors has fallen, the overall number of errors we're experiencing on our economic statistics remains too high, which is an indicator that the improvements need to carry on, and the plan is as important as ever. We've launched our monthly lessons learned retrospective process across all of our statistical output areas, and this is collectively coming together to learn from errors and near misses so that we're driving that continuous improvement culture in the organisation. Next slide, please. So the incorporation of grocery scanner data into consumer price statistics was a major step change. It's improved coverage and quality in the output, and in so doing has modernised and de-risked the production process. And we've built a capability to onboard further large data sets in the future. So a great achievement on that side. And also in consumer prices, we've doubled the sample size for hotels and computer games, which has reduced volatility previously seen in these components. Next slide. I think actually cover 2 slides because I think we've covered that one already. Thank you. Next slide. Thank you. So real-time indicator dashboard. We've now published our weekly real-time indicators on a dashboard, which provides users with a clearer picture of consumer behaviour, business and workforce, energy and housing and transport. And there's a more detailed bulletin also released monthly. And next slide. So on the Special Data Dissemination Standards Plus, we're anticipating being compliant with all the requirements for this by the end of this month. And this is going to be a key international commitment for the UK statistical credibility, which we will have met. And the next slide on classifications and standards. So the final version of the UK standard industrial classification has been published, and that will drive further improvements to surveys, the business register and economic statistics. We continue to work on the standards occupation classification, and we're progressing towards the fuller international macroeconomic statistical standards, and we're focusing on those that will impact GDP and current account relevant to the UK. So more on that in the future. And on the next slide, amongst other improvements we're including the new system for processing government data, improvements to business survey clearance rates resulting from the transition to modern platforms, and increased international comparability resulting from better labour productivity methods. So next slide, cantering through some of these. So loads of great progress we've shown, but there are challenges that remain. As I said before, the plans were complex, are complex, and will continue to require focus. The breadth and the scale of that complexity of what we set out to achieve was considerable, and as we start to deliver some of those improvement plans, we uncover even greater complexity than we planned. So I mentioned that 2/3 of the milestones have been delivered, and the remaining third that we embarked on were slightly more complicated and difficult due to challenges across the board with systems integration. So there's a lot of interdependencies across the systems. Our workforce capacity, there's a need for really specialist experts in these areas that understand the knock-on impacts of changes in one area and the impacts on other areas. The sequencing that we need to do in each of the statistical areas is super important and super complex, so we need to make sure we understand and sequence it correctly. But also we have competing demands in terms of our resources, including as the ONS prepares for the next census in 2031. So we'll continue to work through those challenges. Next slide, please. So with the update of the previous quarter of the plans, we're refocusing and protecting what really matters most in terms of the most impactful economic statistics, and we're rebalancing the portfolio of everything we deliver to protect the real critical deliveries. We've established a structured waiting room approach, which effectively means that only initiatives that have been proven to be ready to deliver, they've got all of the resources they needed, and we have confidence that they can continue to deliver throughout to the end of the initiative. We'll move into active delivery. So it's a way of controlling the demand that we put on all of our colleagues across the organisation. And next slide, please. So what comes next? So focusing on 5 particular areas of improvement. So we clearly have to continue to deliver the outputs, the statistical outputs that everybody relies on in a sustainable way, making sure that the colleagues who are delivering those have got time to invest in their own capability development as well. We're going to be addressing the most urgent quality issues. We've got a new tiering framework that we're using to help prioritise improvements to the statistics that underpin the most critical decisions for our stakeholders. We'll be, as you've heard, and you will hear a little bit more about in a minute, transitioning to the Transformed Labour Force Survey is a key priority for us, as is delivering our statistical business register. Equally, I mentioned the International Macroeconomic Statistical Standards earlier, so that will also be a priority for us, and working through that complex work that will be required in that space. Next, and I think final slide from me, is just to say that our next update will be published in July, and it will be aligned with the outcomes of the recent ONS business planning round, which spans from 2026 to 2029, so it's a 3-year planning horizon. And that publication in July will set out a more refined and realistic set of milestones with clear priorities, which I've just highlighted, and give a transparent account of what is also waiting and we will be pausing delivery on. We'll also include a set of key performance indicators so that we can track our progress and also show our stakeholders how we are progressing against some of those really important improvements that we're undertaking. So that was a bit of a whirlwind, quick rattle through some of the improvements that are in the publication, but I do hope you get a moment to have a read of that in slightly slower time. Thank you for having me, and I'm going to hand it over to Heather.
Thank you, Megan. Hello, everyone, and nice to be here. I'm Heather Beauville, and I'm the Co-Deputy Director for Labour Markets Division within ONS. And I'm just going to go into a bit more detail on the progress with the labour market transformation, particularly the Transformed Labour Force Survey. So if you can go to the next slide, please. Thank you. So as Megan mentioned, the Transformed Labour Force Survey remains a really important priority for ONS for delivering the high quality labour market statistics that we know our users need. And as Megan said, the short core survey, which was a shorter version of our initial Transformed Labour Force Survey to try and help some of the quality issues that we were seeing, was launched in July 25. And we're seeing that is improving the amount of partial data that we get. So we're getting less partial household responses, and we're also getting more complete individual responses as well. So that's really positive. However, we haven't seen the increase in the response rates that we were hoping yet. and attrition hasn't improved as much as we hoped for yet. And I'll come on to some of the more recent things we've introduced, which we hope will help with those things. So the improvements that we've made will be the focus of this presentation, and they are covered in more detail in the article that we put out on the 15th of April, and there's a link in the slides that will be circulated so that you can find that and read the fuller update. So if we can go to the next slide, please, and if we can go over again. So just for those that aren't living and breathing the TLFS every day, I thought I'd just recap on what the design now looks like for the survey, because I know it can be a bit confusing. So we've got what we call a core survey, and that's a survey that focuses on predominantly the labour market content. And so the headline labour market data that you see, that's what we'll be collecting through the core survey. So the first wave of that is now 90,000 households every quarter, and half of those people will go into the longitudinal part of the survey. So they will be followed up every quarter for a total of 5 waves. And then we have the Plus survey, and the Plus survey is it's the old TLFS at the moment, but will evolve with time. And so it still collects the labour market data, but it collects the wider information that we haven't put on the core survey. And so it's just a single wave. It doesn't have a longitudinal aspect, and it's 90,000 households in that single wave. So the core survey is around 17-18 minutes, and the Plus survey is the old length, so around 30 minutes per household. So if we can go to the next slide, please. So just to recap on what the key changes were. So as I've said, the core survey was much shorter, focusing on those headline labour market requirements. We've added in some supported completion. So that is if when we do what we call not to nudge. So the survey goes out and it's online, and we hope people respond online, but we know that not everyone will. So we target we not to nudge to try and increase the response. So not everyone, but some very targeted not to nudge for people that in areas where we're not getting the response that we need. And where we not to nudge there, we now offer or can offer people that just can't complete this survey digitally to be supported in that completion. And so that's a new thing that we've done to try and increase the response and representativeness. As I've said, we have now, rather than 40,000 going into the further waves, and we have 45,000, so that's 50% of the sample going into the longitudinal aspect. And in April, we've introduced data rotation. And data rotation is where instead of a person in every wave of the survey filling in all the information again, so all their demographic information, we just see if anything's changed. So we don't ask repeated questions. So it just makes the user a respondent experience better, and hopefully keeps them in the survey because they don't get fed up of giving us the same information. And so we hopefully reduce attrition. So as I said, that's just gone live in April, and that's one of the big developments since we last updated. So if we go to the next slide, please. So on the Plus survey, just to recap, that's 90,000 sample, as I said. It also has the targeted face-to-face completion as well for non-responding households. It will result in some large annual data sets primarily, but there will be some quarterly data sets available. Our intention at the moment is to calibrate the headline measures from the Plus survey to the core so that there is alignment between those, but that detail is being worked through in the background at the moment. And in the future, while the survey at the moment is the old TLFS, the idea is that that will get some focus and evolve into a sort of more modularized approach for certain topics. But we always said we'd prioritize the core development first and the Plus would follow later. So if you can go to the next slide, please. So I've mentioned one of these already, but there's some further improvements that we've been made. So we've now introduced all the major plan design changes to the TLFS. So as well as that being the short questionnaire and the assisted completion, in April we put live data rotation, which I've mentioned what that is. We've also made some improvements to the pay and earning questions that were on there. Things like aligning the bands that we ask to the national minimum wage rates, which have evolved since the questions were written, and also allowing respondents to respond by proxy. So if I respond, I might respond for my husband as well. So that didn't used to be possible for the earnings questions. And then the third thing we've done is we have increased the incentives across all the waves from £10 to £20. And that's because we haven't seen the increase in the response as a whole that we were hoping from shown in the questionnaire. And the increase in the incentives brings that more into line with other incentives that are offered within ONS surveys, and reflects changes in costs of living as well. So we're watching closely to see what the impact of these changes will be, to hope that they further improve that data quality and the survey performance that we need to see. So if we can go to the next slide, please. So the question that everyone wants to know the answer to is, well, that's really helpful to hear about the updates on the design and what changes have been made, but when will you transition? So our focus now is on preparing for our first readiness assessment in July, and we'll carry that out in collaboration with our main users. In the article I mentioned, there's some more information about what we'll be assessing at that readiness assessment to make it clear what we'll be looking at. However, we know that when we do the readiness assessment in July, we will only have one calendar quarter of data that has those latest design changes in there, and we won't have had time to fully assess that data. So what we know now is that we will need further data collection and assessment that will be needed before we can be confident in our transition. And so now before we said that the earliest we would transition would be November 26, we now know that that will be in 27 rather than 26. Because, as I said, we just won't have enough data to know if how the design changes have impacted and being able to ensure that the data is stable. The decision, though, will still very much be data-led with our users. So we will do the readiness assessment in July to help us build a better understanding of what the next steps look like into 27. And the next readiness assessment will take place no later than January 27, is what we are planning. So if we can go to the next slide, please. So what's next then? So we'll be refining the criteria and conditions for transitioning from the LFS to the TLFS. We've done lots of work on that already, but we are continuing to check them and refine them. As I mentioned, the readiness assessment in July will still happen, and that will give us much clearer indication of the plans after that, and including when the next readiness assessment will be. And that will be no later than January 27. We'll do our next update on the labour market transformation in the summer. So we're expecting that to be in August after the readiness assessment, so we can report back on where we are. And then alongside that, the other thing that we're very busy doing is we are looking at how we can use the admin data to improve the information around the labour market in the UK. And so we've been doing some linking of the HMRC PAYE RTI data to the survey data to see what we can learn. And we intend to publish some of the results from that later in the year as well. And I think that was my last slide. If you can click on, oh, sorry, there is one more. In the meantime, while we are developing the TLFS, we have been making sure that the LFS is good enough for users to use. So we've done a lot of investment in LFS that hopefully you're familiar with, in terms of increasing the sample size, increasing the field work to be able to get out and do the interviews, and in the past increase the incentives on that as well. And what we see is that the response levels have shown clear improvement, and they are now almost all back to their pre-pandemic levels. And the chart shows that with those improvements, we have seen the sampling variability come back to the pre-pandemic levels as well. And so we are hearing from our key users that they are more comfortable with the LFS data. It's increased their confidence in using that, which is good news really, while we get the TLFS ready so we can transition to that. And I think that is my last slide. If you click on, yeah. So I will hand over now for the Q&A. Thank you.
Thanks very much to all our speakers there. We've only got a few minutes left, so I wasn't going to propose, excuse me, to go through all of the Q&A, but I'll pick up a couple. If we just end the recording at this stage.